So, good morning, everyone. So now it's good afternoon, everyone. Today we're going to discuss basics of financial accounting. So those people who have not subscribed my channel, please subscribe for the updates. So to get the updates, you need to press the bell icon. And if you like the classes, if you want more classes like this, you need to press like button. So let's begin with the financial accounting basics. So for any subject, okay, when you start reading any subject for any study, firstly we need to understand what the subject all about. We need to understand what is the purpose of that subject and what is the meaning of that subject. So my basic question is that what is meant by accounting? Please hold for a minute. So my question is that what is meant by financial accounting? Okay, so in early days of accounting, there is only one accounting which we call now financial accounting. Okay, let's discuss that. So during 1495 we had only accounting called financial accounting. What we call as a financial accounting, that we used to call accounting. This is the only branch of accounting. So later on we got other branches of accounting like cost accounting, management accounting, so on. So in earlier days we used to have only one accounting called financial accounting. So let's discuss about what is meant by financial accounting. So what is meant by accounting? We will call it as a financial accounting. Okay, to say in a layman terms, to say in a simple terms, accounting will be called as a language of the business. So this is a question have asked in civil services in optional subjects commerce. So they have generally asked accounting is a language of the business comment. Okay, so generally we call it as a language of the business. Why we call it as a language of the business? See, generally a person doing business wants to communicate his affairs to its users. Who are the users? Users like shareholders or government. We'll separately discuss about the users, but just for the sake of brief introduction, users are like shareholders, like government, like management, employees, or you can also call suppliers, bankers, and customers. Whoever it is, business wants to communicate its information to its users. What kind of information? Maybe business getting a profit, they wanted to communicate that we have got the profit, but they cannot take a mic and they cannot shout that we have got a profit of this year like 5,000 rupees daily. They cannot shout, right? So they need a medium to communicate. They need a language to communicate. Generally, what is mean by language? Language is nothing but medium of communication. Like how we do have C language. So computer, human being wants to give some data to the computer. So C language even written in English, but they have different coding. The same way computer will understand only language which is C language. The same way we need to have one specific language for the business. Okay, Then we started developing a new language called accounting. Okay, generally in layman terms, if someone asks you what is mean by accounting, it means that language of the business. So we do have technical definition. Okay, what is meant by accounting? We do have a technical definition, as every discipline has. Then to learn any language, you need to understand the framework of the language, framework of that particular subject. For example, you had an English. So to write an English sentence, you have to understand when I have to use verb, when I have to use noun. That's called framework. Okay, for accounting also there is a framework. Okay, so that's we're going to discuss in the basics of accounting. So what are the contents will be included in the framework? First we will learn about brief introduction of definition. See, my idea, I'm not going to tell you what is the definition, who has given what definition and all the stuff. I'm going to explain you the contents of the definition, important elements of the definition. Okay, the next, terms of accounting. See, the English meaning of a term, for example, if we call it as asset, this word have a different meaning in accounting and a different meaning in general English. So you cannot apply general English meaning in accounting. Okay, if that particular line, if that particular item have not defined in accounting, you can apply general meaning. But as much as it is defined in accounting, you need to apply that definition which was defined in accounting. Then we will also see GAAP. We call it as generally accepted accounting principles. Then number 4, we will see process of accounting. And before this we also see, I'm sorry to write here, before we also see bookkeeping, accounts and accounting. Okay, so these are the things we're going to look into the framework of the accounting. Okay, then in the process of accounting you will see recording, classifying, summarization, analysis and interpretation. Okay, this is called process of accounting, and in the definition of accounting also it is included. Okay, let's begin with what is the definition of accounting. I'm not going to tease that what is the exact sentence what they have said. I just wanted to give you a brief of what they want intended in the definition. Okay, this is a definition has given by American Institute of Chartered Practitioners. Definition given by American Institute of CPS. So generally how we had ICIs, the same way America also had their own institution for CPS. We call it Chartered Practitioners. So what they have said, I just giving a brief of what they are intended in that particular definition. They said accounting starts from identification, and then after the next step it moves to measurement, then it start recording, then it start classifying, and whatever the data is classified will summarize, and summarized data we will interpret or analyze and analyze. Okay, so what does it mean by identification? So as per this definition, identification means, see, as an accountant of an organization, you will come to know a lot of events was happening in the outside. Okay, for example, there is a car accident in front of your office. Okay, as an accountant, you also came to know that about that, right? There is a car accident, or your owner have bought a jewelry to your wife, his wife. Okay, you came to know that. Okay, as an accountant, while you preparing your books of accounts, you come to a lot of issues, okay, a lot of events. But in this definition, identification says you have to record, you have to consider, not to record, you have to consider only those transactions or events which related to your enterprise. So you have to consider only those transactions which are related or to your enterprise. What is which are related? Which going to be impact your business? Which is going to be impact your business? Okay. Then you have sorted out whether that is related to your business or not related to your business. Your employer bought, your owner have bought jewelry to his wife. It's his personal transaction. It's not at all related to business. It's nothing going to be impacted to the business. Okay, it's not going to take from the business anything, and his personal choice. He bought a jewelry to his wife. Then what about the measurement? As a measurement says, you identified the transaction which is related to your business. Then after, you have to see whether that can be said or said in or valued in money or money's worth. We also call it as that can be said in monetary terms or not. So there is an accident in your office, in your factory. Okay, one of your employee lost his leg. Okay, now can you say that in money's worth how much is the cost for that leg? You cannot. So when you cannot, you should not go to the next step, record. You cannot record. Okay, you cannot record. So sir, when you can record, sir, if you can say that in monetary terms, then you can record. Means if you say that for that employee we are giving 50,000 rupees as a compensation, and that time you can record, then you can go for the next step. That is nothing but recording. So the first, I need to check whether it's related to my business or not. How I say it is related to my business or not, whether that is going to be impacted to your business or not. Okay, then next thing, measurement, whether you can say even that is impacted, whether you have to say whether that going to be in monetary terms or not. You can say that in the monetary terms or not. If you cannot, you will not record. If you can, you will record. Then you record into your book. For that we had two systems. We can record as a journal entries or as a subsidiary books. You have two systems, journal entry and subsidiary books. Then whatever you did here, you will classify. So why the classify is required? See, generally when in a day you purchase for 1,000 times and you sell for 2,000 times, and you will involved in thousands of transactions. So what I will do, I will bring up all the sales transaction at one place, and all the purchase transaction at one place, and all other transaction is one another place, so that the person, the financial user who was looking at my financial statements or my books of accounts, he can understand easily. Okay, so whatever I'm doing in accounting, its ultimate purpose of that is to communicate the users. So I make it as simple as possible that user will understand very easily. Okay, then classify, whatever the classified data, you will summarize, you will make the balances. So that, for example, you made a purchase 1,000 transactional purchases, so you will say ultimate number. Okay, you will say an ultimate number. Today you purchased 50,000 units, then you have written 2,000 units, then you have purchased 60,000, then you have written like this. You made like 1,000 transaction. So I wanted to know what is the ultimate purchase you made. So as a financial user, I don't have a time to check each and every transaction. I need an ultimate result. So how much you have purchased. So that's called summarizing. So whatever you have classified, you summarize. Okay, you bring the balances. That we can also do trial balance. In the trial balance, you generally make whatever the balance amount you will take into the trial balance. So there you can see what are the amount for the purchase, ultimate amount of the purchase, ultimate amount of the sales. Okay, then whatever summarized, then it's okay, fine, you summarize, you said purchase is 50,000. So what is the ultimate result of the business? Ultimate result of the business, I wanted to know what is the ultimate result of the business. You purchased, okay, 50,000. You summarized, you said 50,000 we purchased, we sold 60,000. Did you got the profit or did you got the loss? So give me that information, so that interpret that information, whatever you did till here. So interpret that information in such a way that I can analyze the things. Okay, analyze whether you got a profit or loss and interpret that information. How much purchases I had, this many sales I had, then my profit was 50,000 rupees or my profit was 60,000 rupees. Okay, this is what the definition says. Okay, then what we will do in the base, so that is a first concept of definition. So first we have discussed definition and come up. So first we'll do definition, then terms of accounting, then generally accepted accounting principles, then process of accounting. In the process of accounting, you already have recording. At the time of recording, I will tell you, we have to think two things. We have to think about two aspects. One is when to record and how to record. So we will also discuss when to record and how to record. Okay, that we will going to discuss in process of accounting. Before that, we're just going next concept of us, terms of accounting. Next is terms of accounting. Next is terms of accounting. It's very important because most of the people will get confused here. So first time I'm going to discuss, I'm going to start with asset. See, there is no specific definition for asset. There is no specific meaning for the asset, but we take from the illustrations. Okay, from the explanation. Okay, there is an explanation for the asset, and different authors have given different kind of definition, but every definition have same meaning or same explanation. Okay, we cannot see one book gives one definition and another book says other definition, but the ultimate outcome of the definition, ultimate explanation of the definition has to be same. So we're going to discuss the explanation of that asset. Okay, what is mean by asset? A definition says like this. One of the definitions says like this: asset means any resource controlled by owner, okay, This owner, I will discuss, this owner means enterprise. Okay, any resource controlled by the owner which resulted from past events, which is resulted from a past event from which some future economic benefits expected to flow for company. This is generally they have given this kind of definition. This is resource controlled by the enterprise, means owner, from which resulted from a past event, because we did something in the past. Maybe we purchased, we got an exchange, or we made a research. From that we got a resource which we have a control on it. See, very important, this control. We are talking about the control. We are not saying that we are the owner. Okay, we are the owner or we are not the owner, whether the ultimate control, ultimate decision making on the asset was upon us or anyone else. Okay, sometimes I may not purchase the asset, okay, for the sake of taxation, for the sake of any other purpose, for the sake of law, but the ultimate decision making on that asset, whether asset can be sold, whether asset cannot be sold, okay, if it is upon me, then I will call it as I have controlled. Okay, then which is resulted from the past event. Maybe you did, see, what is past event? First, controlled means owned or not, but ultimate decision making is in your hands. Means, one more point, the most of the revenue generated from asset is attributable for you. You're getting most of the revenue, whatever the revenue. For example, this asset will come for 10 years, but you're using this asset for 8 years. So ultimate, the revenue generation was in your hands. Okay, then which is related from a past event. This past event can be of past event. You made a research, you got a design, or you got a patents, you got a formula, then you got a patents for that. Okay, then that may be my past event. Or I purchased an asset, or I made an exchange, whatever it is, because of this past event you got a resource. Okay, from which it's very important, from which you are expecting some future economic benefits. It means that you keep this asset with you, you keep with these resources with you, and by using it you wanted to generate some revenue. You are expecting, so this asset gonna give me some around like I have bought a machinery. Okay, this asset these resources I'll keep with me, and I will use, by using this I produce 50,000 units per every year. So you are expected some future economics benefit, not an immediate benefit. Okay, so this is a definition of an asset. The next definition we're going to discuss is liability. The next definition we're going to discuss is liability. Hello. Hello. So next concept we're going to discuss is liability. Next definition we're going to discuss liability. So what is the definition of liability? Definition of liability says like this: present obligation, okay, resulted from past event from which expected outflow of economic benefits, from which I'm expecting there will be an outflow of economic benefits, from which I'm expecting there will be an outflow of economic benefits. So whenever you see, for asset I was saying it's an economic benefits, and in liability also I'm saying economic benefits. Economic benefits can be because you're not able to pay this loan or something you bought, present obligation, you're not able to pay that. Then what happens? Generally they'll take your TV or anything else which is economically viable, which will produce your revenue, which you can, with the use of that cash or something, you can produce your revenue. That will be outflow. You will lose that. Okay, that's it. Expected outflow, expected economic outflow of economic benefits. So let's see present obligation. So what is mean by present obligation? So what is mean by present obligation? So whenever you're recording the entry, you check to say that, or whenever you're doing your balance sheet, the classification of assets and liabilities when it comes whenever you're doing balance sheet, or whenever you classifying the entries, when you're doing posting to the profit and loss account and balance sheet, whether it's an asset or whether it's a nominal account, whatever it is, we will discuss that later. But whenever you see this transaction on that particular date, or you're recording, whenever you're recording entry on that particular day, you will see whether this is a present obligation or not. Means presently I required to pay him or not. Okay, for example, I bought a loan on 3/4/2016 and I paid on 5/4/2016, and you are looking on the date of 6/4/2016. I bought the loan and I paid. Okay, now it cannot be called liability, but because on this date is not the obligation, because I had an obligation on this date. When I paid, I don't have any obligation, so my obligation is gone. On this date there is no present obligation. Even you had a loan receipt with you, it doesn't mean that on that particular day you had a obligation. So when you don't have an obligation, we don't first condition was not qualified. So when the first condition is not qualified, we will not call it as liability. Okay, that's called liability. And next definition we're going to discuss debtor. So as per debtor is a person who owes to company. Debtor is a person who owes to the company. Okay, owes means liable to pay. Owes means liable to pay. The person who is liable to pay to the company, we call it as debtor. Generally this will be multiple choice question. The person who owes to the company, we will call it as data. So generally we'll use data of like this. Data for the goods, data for salaries, so data for expenses, or data for services. Like this we're going to be used. But if in your question it is not mentioned anything, just they said data, we will assume that it is because of sale of goods. This data have came to us only because of sale of goods. If nothing is mentioned in your question, okay, if something is mentioned in the question, we will call it as that particular expenses we had a data. Okay, the person is liable to pay the tax. So liable to pay us. And next definition, creditor. Creditor is a person to whom company owes. So creditor is a person to whom company owes. So we are liable to pay him. So we are liable to pay. Owes means liable to pay. So we are liable to pay him. Generally you will also see creditors like this. Creditors for purchase. That is nothing but you also see sometimes goods. Creditors for loan, and etc. So whenever they give like this, we got a creditor for that particular, we owes for that particular purpose. But if nothing is given, we will assume that it is a creditor for purchase. Means we made a credit purchase, so we got a creditor. If nothing is mentioned in your question, just they said creditor, just said creditor. Okay, then after creditor we have discussed asset, liability, creditor. Then we need to discuss one important concept, discount. Discount we had two types. One is trade discount, second one is cash discount. Okay, generally trade discount is given to everyone, okay, for bulk purchase of goods. So this is generally a policy of the company, where if you purchase 2 goods, I will give a discount of 5%. Means whoever comes and purchase 2 goods, they will get a discount of 5%. Okay, then this generally included in invoice price. So generally in accounts, what we will generally do, if this is my invoice, and here you will see description, the description of the goods, then you will see price, right? Generally in your invoice they say 2 goods at 100 rupees, 200, trade discount 10 rupees or something, 20 rupees or 10 rupees, then invoice price is 90. So whenever you pass and whenever you record the entry, you will take this ultimate price after trade discount. Okay, If they said the trade discount got included, if trade discount are not included in the invoice price or price, then what we have to do, we have to remove and we have to take it 190. Okay, will not pass a separate entry for trade discount. Will not pass separate entry for trade discount. So what are the points you require to remember when it is trade discount? It is given on bulk purchases. It is given on bulk purchases and included in invoice. And included in invoice. Okay, the next part. So next, just come to the cash discount. Cash discount is given for the purpose of prompt payment of cash. So generally, for example, you bought a goods on credit. So he has given you 2 months of credit period. Then you made in 1 month. Then he says, if you're going to pay in 2 months, you have to pay me 2000 rupees. Then if you pay me in 1 month, I will give a discount of 100 rupees. So you're required to pay me 1900 rupees. So this 100 rupees is cash discount, but this was not included in the invoice. Not included in the invoice. Whenever he gives the invoice to you, he will give at 2000 rupees. Then whenever you make payment, if in case you make an early payment, he will give a discount. If you're not going to make an early payment, he's not going to give any discount, so that it is not included in invoice. So separate entry needed to make. No separate entry required. Adjust in cost of purchase if it is not adjusted. Okay, we have completed asset, liability, creditor, debtor and discount. Next concept we need to discuss is good. Good means any resource meant for resale. So here, while you purchasing, the purpose of yours has to resell. Means I will get revenue. I bought a resource, I will get revenue by selling it. I will get a revenue by selling it. It is called resource. When you have to think, when you are purchasing, you're expecting that I will sell this particular mobile phone or particular calculator. By selling this, I will get a revenue. So in that case it is called good. So what will be the difference between good and asset? Asset is something which is you're holding, and by holding, and you wanted to produce revenue by holding it. Okay, from that, good is something which you wanted to sell to others. By selling, you wanted to get some revenue. Okay, so different kind of person will treat different resources as a good. Okay, that is what good means. And here, whenever we discuss asset, so asset can be of non-current asset. Earlier people used to call it as a fixed asset, or current asset. So generally any asset which you are expected to produce revenue for more than one operating cycle. In case of manufacturing companies, or in case of 1 year, 12 months, generally it is in case of trading concerns or service. Any asset you're expected to produce revenue from that asset is more than one operating cycle. It will be called fixed asset or a current non-current assets. If any asset which you're expected to generate a revenue within a year, within a operating cycle, it's called current asset. Okay, or 12 months. So where if you bought an asset where you expecting from this asset I will get a revenue which is lapse only in this particular year, only in 12 months. So when I do this classification, you will do this classification on the date of, generally it will be on the date of balance sheet. So on the date of balance sheet you will sit and you will start classifying whether it's a current asset, whether it's a non-current asset. Okay, so till here we are discussed some words like this many words. Then later on we will also discuss certain other kind of words as when it is required. So we have somehow done with terms of accounting. Now we need to go with generally accepted accounting principles. So next concept that we're going to discuss, generally accepted principles. Generally accepted accounting principles, we call it as GAAP, which means generally accepted accounting principles. So what are they? The first one of generally accepted accounting principles is concepts. It includes principles, conventions. So it will include concepts, principles, conceptions. We call it as GAAP. Okay, then So generally, concept is a theoretical one. And theoretically, I'll say something like it's not made as structured, it's not organized, it's just a concept. It just explains about some particular theory. That's called concept. The principle, when you organized it, when you made a rule, it's called principle. Then convention is a tradition. It's like a tradition from a longer period in that particular country. It is a convention to write debit on left hand side, credit on right hand side. It is a convention, it is a tradition. In that particular country they are writing right hand side is credit side and left hand side is debit. If some countries will write left hand side credit and right hand side as a debit, that is a convention, that is a tradition, that country is following from the longer period. So that is called convention. So what are the concepts and principles? So there is no different distinguish between concepts and principles. Nowadays people are calling both or has a similar. So concepts and principles and conventions. So first concept and principle we have to learn is very important, is going concern. Okay, first concept we have to learn about the going concern. So what going concern principle or concept says, whenever you're presenting your financial statements, or whenever you're recording your entries, or when you preparing financial statements, you need to assume that you should keep that in the mind. This particular organization is going for the forcible period. Means whatever period it will go. It will be not winded up in the near future. Means in the coming future. Why this principle is required? Because of this principle, what I do, take care of my assets and my liabilities. Okay, I'll present my financial statement for a particular period, or 6 months or 2 months or 3 months. I will take care for the particular period because I was thinking that it will go for a forcible period. Okay, if I think that will be liquidated in next year, if it is going to be liquidated in the next year, so I don't care about my asset, I don't care about my liabilities. Whatever amount there with me, whatever the assets are there with me, I will sell it off. Okay, so whenever you are doing business, whenever you are presenting your financial statements, you have to present by keeping in your mind this business going to be go for a longer period, not a shorter period. That says going concern. So going concern, in simple line I can say, this principle says business will run for forcible period. Matlab not liquidated or closed in near future. Then next principle we're going to talk about business entity concept. So this concept says whenever you have your owner and that owner is doing business. So as an accountant, you have to keep one thing in your mind while you preparing your while you recording your entries, or while you preparing your financial statements. One thing you have to keep in your mind, that your business and its owner as a different individual, has a different or separate individuals. So because this business related to the owner. So if owner takes 5,000 rupees from the business, what happens? Nothing will happen. But thing is, you at the end of the day, you don't know what is actually business is doing. Okay, whether business is performing well or not performing well, you not able to figure it out, because owner bought 50,000 rupees in the business. Okay, they purchased a good which they sold for 70,000. Then this, out of this 70,000, owner have taken 30,000 and kept 40,000 in the business. Okay, whenever you see 50,000 you have in 50,000 you have bought and 40,000 was left, means 10,000 is a loss. But you are not considering the 30,000 which is taken away by the owner. Okay, then entity concept says that you have to treat business as a different individual and owner as a different individual while you preparing your financial statements, while you recording your entries, while you recording the transaction in your books. So entity concepts, as per entity concept, whenever owner invested in the business, for the business is called as a liability. The reason, at the end of the day, business has to pay, because it's a different individual and it's a different individual. So whatever amount is given by the owner to the business, we will treat as a liability to the business. That's the reason we will write on the capital, we will write on the liability side. Okay, in short note, as per entity concept, owner and its business treated as separate individuals. Owner and its business will be treated as separate individuals. Next concept we're going to be discussed, periodicity concept. This is also called period concept. See, first point, the going concern concept have served. Going concern said you have to assume your business has to go for forcible period. Okay, so I was assumed that this business will go for 100 years. So while you're doing business, you have to think that this business goes for 100 years. Then it's to evaluate every year that whether it's go for 100 years or not, you have to take a specific period, that you take 6 months and check whether your business can go for forcible period or not, right? To prove going concern concept, to make sure that going concern will there in that particular business, you need to prepare your financial statement for a particular period. That period can be 1 year, that period can be 2 years, that period can be 6 months. Okay, the periodicity concept says that in a regular intervals, company required to prepare their financial statements. Company is required to prepare their financial statements in regular intervals. That regular intervals can be anything. So they have to take a particular period. Okay, that particular period may be 1st April to 2016 to 31/3/2017, maybe 1 year. So in this particular statements, they have to take all the expenditures and incomes on the assets and liabilities, all the expenditures and incomes they have to take, which is incurred from this and this only. They cannot consider that expenses which going to be incurred or that expense which is already incurred before. Okay, there are some exemptions, but we are not going to discuss that. But they cannot take whatever the expenditure incurred earlier or whatever the expenditure going to be incurred after that. So they have to take all the expenditures and incomes which is relating to that particular period. Okay, they should only record only those transactions which was occurred during this particular period. So they have to divide this forcible period into a small periods. Okay, that's called periodicity concept. Next concept is matching principle. Next is matching principles. Next is matching principles. So matching principle का मतलब क्या है? So matching principle says that whatever revenue you had, you need to have equivalent. You should also, if you wanted to recognize your revenue, you should also capable of recognizing expenses incurred to getting this revenue. So I wanted to recognize the sales of 50,000 rupees. You cannot recognize as you like. You can recognize only when you are capable of recognizing those expenses which are incurred to get that revenue. Okay, then there is one more point in this. If you wanted to recognize expenses, so from expense side, if you wanted to recognize expenses side, you should match with this expense should match, means not as equal, but this expenses should match with an income. See, these concepts talks in a two ways. See, for example, there is a company. I was a person who wanted to show some dummy sales. Okay, I wanted to increase my profit, so I was increased my profit. So the concept says you cannot increase your sales as you like. So show me the expenses which you have incurred to get that income. That's fine. Okay, good. So it is also says when you wanted to recognize an income, from income point of view, when you wanted to recognize an income, you should also recognize those expenses which you have incurred to get that income. It's fine, well valid. But what about the expenses? So now I wanted to write an expenses whatever I like. Okay, whatever expenses I like, I wanted to write. Then no, you cannot write like that. Match with your income. Whatever income you have incurred 50,000 rupees as your purchased goods. You cannot write your 50,000 as a purchased good when you cannot record your income. Yeah, so we had a doubt. Let's see. I bought a 5,000 units of goods. Okay, out of this 5,000, I have sold only 4,000 goods for 10 rupees, so 40,000. This 5,000 goods I bought it 5 rupees each, 25,000. So then if I'm preparing my profit and loss account, or if I wanted to recognize, if I was 4,000 into 10 as my income I was showing, the related expenses is you have to show 4,000 into 5 rupees, only 20,000. So remaining 1,000, it goes as your closing stock. You need to adjust in this 5,000. When you in your purchases, you made a 5,000 units purchase into 5 each, minus 1,000 which is closing stock into 5, then 4,000, 20,000 you will take to your P&L account. So whenever it talks about your P&L account, so whenever you write on your debit side, write only those expenses which you are incurred to get this expense. But there is an exemption for this rule, is the period cost. There are some costs irrespective of you doing business or you're not doing business, you going to be incurred. That's called period cost. Means monthly salaries I have to pay. I didn't made any sales, but I have to pay monthly salaries. But sir, was that salaries related to sales? Yes, it is related to sales, but not directly. It is related to sales indirectly, because it facilitates the sales for smooth functioning. For example, I don't have an administration who look after my accounts. So owner himself has to come and look after the accounts. If I had an accountant, it makes me smooth functioning, but it is not directly related to my business, not related to sales. Even there is a no sales, even there is a sales, I have to pay salaries. But the ultimate purpose of that administrator is what? It's for the purpose of sales. So you're going to incur for the sales only, but it is not directly related. It is indirectly related to your sales. It is indirectly related to your income. So if it is indirectly related to income, even though that you have to recognize. Okay. So the period cost was indirectly related to income, needs to be recognized. Okay, even there is no direct matching to that income, but even there is an indirect matching, so you can recognize that as your expense in your profit and loss account. Matching principles talks about the profit and loss account. The next is cost principle. This principle generally is nothing but, when I was passing entry, at what price, at what value I have to record. You cannot say a purchased asset. You have to say purchased asset. You have to say in monetary terms. So what is that monetary terms? At what price I have to record my asset? That's my question. Whenever I had an asset, at what price I have to record? The cost principle says you have to record it historical cost. You have to show. First, you have to record it historical cost, and you have to show in your balance sheet at historical cost. So recording at historical cost and showing in the balance sheet at historical cost. Okay. I bought an asset 2 years back, 5 lakhs. Okay. After 2 years also, when I was preparing my asset, I have to show it 5 lakhs. Means there is a depreciation and all stuff that we will discuss later. But I have to show it 5 lakhs. And there is one more concept called realization principle. See, historical cost says your asset will be recorded at historical cost. Means if I bought it 5 lakhs, you have to record it 5 lakhs, 1 lakh rupee. So 4 lakhs. Right? Historical cost of 5 lakhs. But realization concept says that you have to record at the cost which you can get from market by selling. So I bought a land which is 5 lakhs. Okay, after 10 years the value of this land will be around 50 lakhs. But if you go as per historical cost basis, that is a cost basis, cost principle, it says that you have to record it historical cost. You have to record it 5 lakhs. But are you giving a genuine presentation to your financial user? No, because it's a worth of 50 lakhs. You're showing it 5 lakhs. You're saying them, it is just a 5 lakhs rupees. But actually it is a 50 lakhs rupees. So realization concept says, no, you have to show it 50 lakhs rupees. Okay. So if I was doing for every asset, like this for every asset, then every year the asset cost will change. Then what accounting will suggest is, what experts will suggest, you should not go either by the historical cost. Most of the times you go by historical cost. In occasional basis, you go by realization basis. It means in occasional, you revise your cost of your asset. If that asset is revision is needed, revaluation is needed, just revise the value of that particular asset. And that's the reason we also got a concept called depreciation. Okay, depreciation we got because of matching principle. Okay, the matching principle and the realization principle, the combination we have got depreciation. When we discuss depreciation, we will discuss that. So next, we're done with now. Next concept I'm going to discuss is conservatism. This principle says, just in simple words, this principle says anticipate losses but not gains. It's very simple. When you know see, this principle is overriding periodicity concept. This principle is overriding periodicity concept. Reason in periodicity concept, it says you need to record only those transactions which is between happen between this year, okay, during this year. But conservatism principle says if you know any information regarding with the next year is as well, that you're going to incur any loss, then you have to record in this year itself. As soon as you come to know, you have to record. So it says that you have to be more conserved, so that any losses in the future that you think it's going to be happened, then you have to recognize as soon as you come to know. For example, my books was closed at 31/3/2016. Then I came to know on this date the particular data, the particular person who I am given loan, the person to whom I have given loan, he died. So he has to pay me in the next year 7th month. So he don't have any children. So this information I came to know on 33/2016 or before 33/2016. So but it is related to the next year. Okay, it is related to the next year. But conservatism principle says you know this year, that's recording this year. Record as soon as come to know. So it is overriding. It is an exemption. This concept is overriding periodicity concept. Conservatism concept is overriding periodicity concept. Conservatism principle says that anticipate losses but not gains. Don't anticipate gains. Okay, maybe in the next year you have to pay 50,000 rupees to your creditor. Okay, but he has died the same 7th month. Next year 7th month you have to pay, but he is died. So don't anticipate that. Don't recognize that right now. Okay, anticipate losses but not gains. It's good for your business. So next principle what we're going to discuss is consistency. So next principle is consistency. What this principle says, whatever you're doing in your business, okay, however you're presenting your financial statement in your items presenting in your financial statement, you have to present in the same way consistently. Okay, for example, a particular item you're treated as asset. Okay, particular item you have treated as that too fixed asset. Okay, then you have to classify this item year after year as asset. Then next year you should not say it as a good or it is something else, it's as liability. So year after year we have to say same thing. See, consistency or of two types: internal classification. See, I have 5,000 books, okay, in my business as an asset. For 5,000 books, out of 5,000 books, you said 2,500 books as printers. Another 500 books you said as pages. And another 2,000 books you said as books. But you have same books. There is a no change, no distinction between this 2,500, 500, 2,000. So you cannot classify one particular books as a printers, as a pages, as a book. So having any item having same characteristic, okay, any asset having same characteristics, same features, you have to classify with the same name. You cannot say for the particular 2,500, 500 and 2,000 books. For 2,000 it is a books. Okay, then whatever you are classified, whatever you have made a classification, you have to make a classification, same classification year after year. You cannot change. This year you said books, next year same item you are going to say as pages, or next year you're going to say as a printers. You cannot say like with the same books. You cannot classify with the different names in year after year. Within the same year, you cannot classify certain books as a books, certain books as a printers, or certain books as a pages. Okay, this is one. Then when it comes to, it also says if you have used any policy का मतलब principle for and method. For example, to calculate depreciation, we have a method called SLM and WDV. We have two methods, and this year you have used SLM method, and next year also you should use same SLM method. You cannot change into the WDV. You cannot change that method into the WDV. It says that apply accounting policies consistently year after year. So apply accounting policies consistently year after year. So within apply the classification of your assets within a year, same having the same characteristic, apply same name, and year after year also you have to apply same name consistently. If you said this year books, next year also you should say books. Okay, if not, it is always misleads your financial user. Okay, the ultimate purpose of your maintaining books of accounts and writing accounts is to give information about your business to the users, so that users can understand, they can take a decision upon your business. So this is one more concept called consistency. Then there is one more concept called dual aspect concept. There's one more concept called dual aspect concept. This concept says if you wanted to gain something, you need to sacrifice something. So your gain always equal to your sacrifice. So whatever you get, you need to sacrifice something. So it is also says your every debit will be equal to your every credit. Okay, then it is also says if your asset increases, it is corresponding with you will get a liability increases, or any other asset decreases. Let me explain. Now I want a television, TV in my house. I have two options. I can take on loan, I can put my own cash. So imagine my cash is my asset and this is also my asset. This is a loan. This is a liability. Right? What I did, I thought by using my cash, I will get this asset. Okay? So I thought this. So I'm getting my asset got increased. I'm getting this asset, right? TV, and one more asset called cash is decreasing. So it says if asset increases, another asset will decrease. Or I have second option. What is my second option? I can get this TV by having a loan. So means my liability is increasing, my asset is also increasing. So second equation, it says if your asset increases, then your liability also get increases. Okay, then ultimately my assets equals to my liability, or I can also write my asset equals to capital plus outside liability. Capital is nothing but a business bought this asset by using owner's fund, owner's money. Then this is what so vice versa, when my liability decreases, my asset also decreases, because I have a liability of 50,000. To pay this, I need to use my cash. So my cash also get decreases, my assets is also get decreases. So it is always in the positive direction. Okay, if it is increases, it is also increases. If it is decreases, it is also decreases, and asset increases, it is also decreases. So one liability increases, I have two options. Another asset increases, or any other liability decreases. Okay, this is the option I had. So what we're going to discuss the next concept. We have discussed almost all the concepts. Yeah, there is one more concept is money measurement concept. Yeah, this concept talks about two things. One, whatever you wanted to record in books of accounts, you should capable of saying that in monetary terms. It means money or money's worth. And second concept, it says whenever you're preparing your financial statements, one thing you have to keep, you have to write denomination of currency. See, after globalization, what happened? Whatever financial statement you are presented in India will be seen by the people who was in America. Okay, so what you will write, generally you did this like amount an amount. Okay, you didn't write whether it is rupees or whether it is a dollar. So 50,000. Those people who was in America, what will think? They think it is a $50,000. Those people in India, they will think it is a 50,000 rupees. So it is creating confusion. So it says that you record only those transactions which you can say in the money's worth, and even after that, it is also saying that write the denomination of the currency, whether it is in rupees or whether it is in dollars. Just say whether it is in rupees or whether it is in dollars. So money measurement concept says two things. One, record only those transactions which we can say in monetary terms, or write denomination of the currency. Okay, whether it is a dollar, whether it is a rupee, whether it is a euro. And next concept it talks about full disclosure. Okay, so whatever the transaction you are entered, okay, you have to disclose it fully. Means, for example, you made a sale of 60 lakhs, but you are not recording entire 60 lakhs, you're just showing only 40 lakhs. Okay, so whatever you're doing, just disclose fully to your financial users, okay, whatever your expense, just disclose everything fully. And if there is any changes in accounting policies or about contingent liabilities which you cannot show in your financial statement, but which will impact your business, at present or in future, you need to disclose that fact as a footnote to your financial statement. You have to disclose even that fact, even it is not in a monetary terms. You have to disclose that fact if that is going to be impact your business. Okay, the next concept we're going to discuss is materiality. So this concept says record those transactions not records, I'm sorry. Recognize those transactions which will show impact on decision making of users. So material items, just disclose the material items as a special line items. So what about the immaterial items, sir? It's not that you should not show it. You can show it, but you can like for example, there is a stationery like eraser, a pencil, pens. For example, I was doing a 5 crore business. So in that I have a pencil which is of 2 rupees. Because of this 2 rupees pencil, will my financial user change his decision? Like because he had a Apsara pencil, I should invest in his company. He should have a pencil. That's the reason I have to invest in his company. So it will not make any impact on his business. So in that case, I will not show this pencil as a special line item. I just include this as a stationery. Like whatever the eraser or whatever the amount is there, I'll use as a stationery. I'll use as a miscellaneous expenses. Like I bought a tea, I bought a biscuit packet. All these expenses I will show as a miscellaneous expenses, because that will not showing any impact. So I will not show that as a special line item. Okay. For example, there is a person who was doing a stationery business. For him, eraser is the biggest thing. Okay, his business itself is 100 rupees say per day. In that eraser which cost him 5 rupees, for him it's showing a lot of impact, that 5 rupees. So I'll show that as a special line item. So whether it's a material item or it is an immaterial item, it depends upon the business and turnover of the business. If the turnover of the business was 500 crores, where you are showing which is item which is costing me that 1000 rupees, it's an immaterial item for the users. Okay, but for a business which were having 5000 rupees as a turnover and they lost a book which is 500 rupees, for them it is a material item, because that going to impact users mindset. That is, users is also included owner, right? Owner is also included in the users. So the material item or immaterial item, it depends upon the business and turnover of the business and how it is going to impact on your business. But materiality concept says recognize only those transactions which are material in nature. Okay, it's not that don't recognize it in material nature, you can recognize it, but recognize as a miscellaneous expenses. Don't show as a special line item. Don't write pencil. If you purchase a pencil account debit to cash account, write the miscellaneous expenses account debit to cash account. You purchase an eraser, don't write eraser account debit to cash account. Okay, don't write all these small expenses in your book and don't show as a special line items. That says a materiality concept. So we have done a lot, most of the concepts which are needed: going concern, consistency, accrual. So next concept is we're going to discuss accrual. This concept talks when to recognize a transaction. See, I said periodicity concept. Okay, from Fern to 2016 to 31st/3/2016. Okay, I had a transaction which was occurred in 1/4 to 31 December 2016. Okay, I made a sale to a person, okay, on this particular date. The amount related to this was received on 1/8/2016. Okay, when should I recognize? When should I record? Whether I should record at this point of time or whether should I record this point of time. So accrual concept says to you, you have to record the transaction. You have to record the transaction as soon as it's occurred. As soon as it occurred. So when it is occurred for the first time, here, right here on this particular date, so then you have to record the entry on 31st December 2016, as well as then it is also occurred, it is also happened, payment also received in 1/8/2016. You should also record this payment entry. Okay, so it is also occurred, whatever the transaction is occurred, also and the date which is transaction is occurred, you have to write on that particular date. And if you're following accrual basis or accrual concept, you will get two aspects. One is due entry, you will see, and you will also see payment entry or recipient. So you will get a complete information if you are following accrual concept. Okay, so on the accrual concept, you have to record entry as soon as it's occurred. So based on that, you will write two entries for every transaction. First is due entry you will write, and also the next transaction, also payment. So for the financial user, he can say for a particular transaction, this is a due amount he required to pay on that particular, another particular day he had paid. That information you can directly, the user can directly collect from your records. So your records will be very clear. Next, there is something called basic accounting assumptions. Actually, as per ICAI, we had three basic accounting assumptions. They are going concern, consistency, accrual. So when I was seeing a profit and loss account and balance sheet and ledger accounts and so on, journal entries of an organization, I feel that they have followed these three basic accounting assumptions. They must follow, and I assume that as a financial user they have followed it. Okay, what is that? Consistency. So I feel that when whatever he was presented in the balance sheet is also presented as how he presented in the last year, so that I can compare this year profits with the next year profits. Okay, then going concern means when I was investing, I will think that this business will go for foreseeable period, not to the near period. If it is not going, you have to disclose this fact. You have to disclose this fact by saying that this business gonna be closed down in near period. This business going to be closed down in the next 2 years. That fact you have to disclose. If it is not disclosed, as a financial user, I will assume that this business is going for next 10 to 15 years or next 500 years. Then whatever the books you have prepared, you prepared on the basis of accrual. On accrual basis, not on the cash basis. We had two bases: accrual basis and cash basis. Cash basis says that you have to record the entry on the time. You have to record the entry at the time either you got receipt or payment, on the date of payment or on the date of receipt. So I will not assume these people have prepared books of accounts on this basis. I assume these people have prepared accounts on the basis of accrual basis, where I do have due entry and also have payment or receipt entry. Okay, so if any of these basic accounting assumptions are not followed, any of these basic accounting assumptions is not followed, you need to disclose that fact in your disclosures. Okay, in your disclosures you need to, if you are not followed, you need to disclose that fact in your disclosures of accounting. So let me know if we had any doubts in the chat box. So next, so see, when we are discussed, now let's see. So we have said, when we are doing the definition, we have told that identification, it starts from, then it goes to measurement, then it goes to recording. Okay, then we start next concept of us, process of accounting. So what is the process of accounting? This identify, and it starts from not only identifying, then measuring, then recording, then ledger posting, then trial balance, then profit and loss account or balance sheet, then profit and loss account or balance sheet. Okay, then first we start with recording. So first our concern is on recording. See, for recording you have two ways. So where I can record, okay, how I can record, first thing. So how when you can record, you have two things. You can see where I can record, where I should record, and second one is when I should record. I mean when I should record in my books, identified, measured, okay, now I should record or I should record on the later date. And where should I record, we will discuss now. And how I have to record, what should I know to record the entry. Okay, so where I should record, for these you have two books. One is journal entries, second one is subsidiary books. Journal entries as well as subsidiary books. When to record, you have two bases. One is cash basis, second one is accrual basis. How to record, we will see. Okay, first we'll discuss about whether you are recording the journal entries, whether you are recording the subsidiary entries. Subsidiary books we record in a different way. Okay, then I just pick journal entries. So when to record is same. Okay, but how to record, if it is journal entries is different, and if it is subsidiary books it is different. Okay, then how to record, we will discuss. If it is in journal entries, how we have to discuss. If it is a subsidiary books, we will discuss how to record. Okay. Okay, even it is subsidiary books, even it is journal entries, this both or when to record will be same. Okay, what basis company is to follow. So first I choose journal entry. You are writing recording in journal entries. So first my question, when to record, then you have to check which basis company following, or you can also say organization following. if they following accrual basis or they following cash basis. If they are following accrual basis, they should record as soon as transaction occurred. They have to record as soon as transaction got occurred. Then if they are following cash basis, they should record whenever they realize receipt or whenever they make payment. Let me summarize with this an example. So on 1/4/2016 I bought a goods on credit. You bought a goods on credit. Okay. Then the payment related to this you made on 1/4/2016. 5/4/2016. You bought a goods on credit on 1/4/2016 and you made a payment on 5/4/2016. Right? So my question is, when I have to record this, okay, on this date, I should record on this date or I should record on this date? Which date I have to record? So for that I need to understand which basis you are following. If you are following accrual basis, you have to record on this date due entry. Okay, then also you should also record on this date payment entry. Okay, you have to record on the both the days. So you have to record on both the days. So if I am following not accrual basis, if I am following payment cash basis, I should only record on this particular day. I should record my entry on 5/4/2016. There is no need of recording entry on, and there is no need of recording entry on 1/4/2015. That is what. So we had 3 questions. First, where to record, whether to record in journal entries and whether to record in subsidiary books. Second, we had a wait. Okay, we have this question. So we got a answer for accrual basis or cash basis. We got that. So then next my question is how to record. Next question is mine is how to record. So to understand how to record, so there is 2 things we need to understand: transaction and event. So event, first we need to understand what is an event. So we need to understand what is mean by event. So event is any happening in the organization. So for example, you will be knowing a lot of events. So there is a birthday party in the organization. A client is died. That is also an event. Event can be external. Event can be external. Event can be internal. My client got died. I know that fact. Okay, and I purchased goods. That is also an event. So event can be anything. It can be external. It can be internal. Okay, a transaction is nothing but an event where involved in exchange of money and money's worth. So event can be anything. So like I got a new car, my employer got a new car, it is also an event. But to say an event has a transaction, it should be involved in money or money's worth. Okay, it's exchange of monies and money worth is called an event. It should be an exchange of an event which involves an exchange of monies and money's worth is called event. Okay, for example, there is a birthday party. In my organization, it is nowhere related. I am not company have not given any money. The employees of this company was celebrating this birthday. So this is an event, but is there any exchange of money or money's worth? Means, did I got a cake? For that cake, did I paid anything? I got a cake and I paid something, so there is an exchange. Then it's called a transaction. So you need to understand event and transaction. Event is something which can happen internally and externally. Whatever it is, something has happened, we call it as an event. Then transaction is something which event were involved in exchange of monies and money's worth is only called transaction. So then let's begin how to record. Then every transaction, just listen carefully, every transaction have two things. One, you have to sacrifice something, you have to gain. So to record the entry, what you have to do is a sacrifice, what is a gain. Okay, this keep aside. Then before that, you need to know one concept for recording: a classification of accounts. There is two types of classification: modern classification and traditional classification. Generally this is given by England, this is given by America. Something is given by England and another one is given by America. Okay, so under this classification, under traditional classification, under traditional classification, accounts are classified into three categories. One is personal account, second one is real account, third one is nominal account. Okay, Then in personal account, it's personal account further classified under natural person, artificial person, natural person, artificial person, and representative person. Then in case of real account, it can be, see, I can also say real account is it is like assets, property which having a physical existence, and those assets which not having physical existence. See, I can directly say that any asset which is not a personal asset, personal account in nature, can be called as real account. Any asset which is not in a nature of personal account will be called as real account. For example, human beings, if for example debtor is an asset and is a personal account, so it will not fall under real account. But a table which is not a person will falls under a real account. So next is natural person, means the person who was born, okay, like Ravi, Suresh, persons, this is all real persons. Artificial person, this is not the real naturally born persons, this is not a natural persons, but court or law recorded them as a person. Then what about the representative personal account? So generally the representative personal account, see, for example, a company have taken goods on credit from 5,000 customers. Okay, is impossible for company to write that 5,000 names in their balance sheet. So they represent with a name called debtor. Okay, so they represent with a name called debtor. So it's when there is an impossible to write 5,000 names, natural person's name, they represent with a debtor. So representative personal account can be an artificial or a real natural person which having a same characteristic. Everyone have given a loan for me, so I keep in another name called loan, which is a representative personal account. Okay, then real account already I explained. Then what is mean by nominal account? So what is mean by nominal account? Nominal account, any expenses or losses or any incomes and gains. Any expenses and losses or any incomes and gains. So first, in the first step, how to pass entry. First, in a transaction, you should be capable of bringing up what you going to sacrifice, what you have gained. Okay, then you bought that out. Then what you say, this year bought something and you bought something. For example, sold goods to Ramesh. So what I got is goods, I gained goods. What I sacrifice, a future right to Ramesh. I am liable to Ramesh. That is why I am going to sacrifice. The Ramesh is my sacrifice. Why I am taking Ramesh? I can write the future right on my money to the Ramesh, but it is a lengthier, so I was writing Ramesh. So I am liable to Ramesh. That is what I am going to sacrifice because of this transaction. What I am going to get? Good. So good. Now at present, it's a nominal account. Just I'm saying, let's classify this is a personal account. Then apply the rule. Okay, so we will going to discuss that rule right now. So we are going to discuss the rules right now. So we are going to discuss the rules. Rules of accounts. So rules of accounts, you have 3: personal, real, and nominal. Debit and credit. So debit, the receiver, credit, the giver. Real account, debit and credit. What comes in? Credit, debit, what comes in? Credit, what goes out. Here debit and credit. Debit, expenses and losses. Credit, incomes and gains. Okay, the receiver, the giver. The real account, what comes in, what goes out, and nominal account, expenses and losses, and incomes and credit, incomes and gains. And tomorrow class we will do in detail, but today just I'm giving a brief how to pass an entry. So now I will apply the rule. Debit and credit. So receiver, giver, debit and credit, expenses and losses, incomes and gains. So now apply the rule. So I bought a good, I purchased a good. Okay, the purchased, so just imagine, I will explain you why purchase is an expense, but just for sake now, just it is an expense. Sake of now, just remember it is an expense. So as per nominal account rule, expense you have to write on the debit side. So debit side I will write expense account. Okay, then as per this transaction, was he as a giver of this particular goods or a receiver of this particular goods? Was Ramesh is giving these goods or receiving these goods? Means he is a person who was giving these goods. So I will write him on the credit side by saying Ramesh will be credited. So generally, if anyone is aware of how to pass an entry, so I will write goods account debit to Ramesh account. Okay, instead of this goods I will write purchase. I will tell the what is the reason we have to write the purchase. So my entry will become purchase account debit to Ramesh account. Okay, my entry will become purchase account to Ramesh account. So today we will end the class here. Then those people who have not subscribed my channel, just subscribe. You will get costing class as well, and also you will also get videos on accounting as well as on tax and cost accounting, cost and management. That's the cost accounting. Okay, thank you for watching my video, and we'll meet again, and have a great day. And just don't forget to subscribe, like, and share bell icon. This 3 4 1 2 3 4 things, don't forget. And thank you for listening to us. Thank you.